morning, everybody, and welcome, and thanks for being here today. My name is Martyn McCathie. I'm the investment specialist at Wilson Asset Management, and it's my pleasure to welcome you all here today. I'd like to start today by acknowledging the traditional owners of the land in which we meet today, the Gubbi Gubbi people, and pay my respect to elders past and present, and also acknowledging you, our shareholders, for making the effort to be here today. We appreciate, the team and I love coming to these events and spending time with you. But also the trust that you've instilled in us to be stewards for your capital. We get to turn up to these events, which we love, as I've said, but we also get to do what we love doing and investing on behalf of you. So thank you for that trust. On the disclaimer today, we're going to run through with our investment team this morning. I'll touch on the agenda for the day shortly, but just a broad disclaimer to say that anything that we do talk about today is general in nature. We are not licensed to give financial advice, and if we do spark anything that has an interest for you today, do seek independent financial advice. Running through the agenda as we'll go through today, we're going to have members of our very, very talented investment team up on stage shortly. We're going to run through, we've got Will Liu, who's going to present on WAM Global, John Ayub, Portfolio Manager for WAM Leaders. Going down the market capitalization, we've got Will Thompson, who will run through WAM Capital, WAM Active, WAM Research, and WAM Microcap. Then we'll have Dania Zinarova to present on WAM Alternative Assets, one of our newer listed investment companies. So for anyone that doesn't know WAM Alternative Assets, we took on the management of that portfolio a little over 4 years ago. As Dania will explain, we're investing in private markets there, and it's a really interesting space. So hopefully something interesting for you there. The team and I will then come back on stage and we'll run about a 45-minute Q&A. Part of this is getting your feedback, answering your questions. So we'll leave plenty of time for Q&A at the end. And then after that, we've got the team from Future Generation. So Caroline Gurney, CEO, two products that I'm particularly very passionate about. I'm on the investment committee for both of them. And they're two funds that were established by Jeff as a way for the financial services community to give back. So if you're not aware of those products, all of the fund managers and service providers give their time and expertise pro bono, and that allows the companies to donate 1% of its net assets to not-for-profit organizations. So very different product within that listed investment company structure that we love. Before I pass on to Will, I just wanted to kind of touch on Wilson Asset Management as a business. Obviously, you'll have heard Jeff and Kate up here in the past talking about our purpose and our desire to make a difference for you, our shareholders. And we primarily do that through investment returns, but also advocacy. You'll have seen that we took a strong view in 2019 with franking credits and the potential abolishment of franking credits. And it was a cause that was very close to our heart, and it was for a lot of our shareholders as well. And at the moment, we're going through similar advocacy campaigns, whether that be the super cap, the 3 million super cap, and the illogical taxing of unrealized gains within super. Jeff and our CFO, Jesse Hamilton, very active in lobbying government there. And also the sophisticated investor test, trying to level the playing field for retail shareholders. It's a very important part of what we do. What helps us along the way and helped us enormously when we were doing the franking credit campaign back in 2019 was your feedback and your stories. So if any of those subjects do touch you and you've got stories that you want to share with us, it definitely helps us when we're lobbying on your behalf. So, when we're out tonight, or this afternoon, having a sandwich after the presentations, come and introduce yourself to one of the team. We've all got name badges on. Or email in your stories. So with that, I'll pass to Will. He's flown all the way from New York to be with us today. So touching on what's happening in the US and our global portfolio, Will Liu.
Thanks, Marty. And thank you everyone for being here. My name is William Liu. I'm the senior analyst on the WAM Global Fund, ticker WGB. So as Marty said, I've been based in New York for just over a year, and I'm extremely excited to be here, back in Australia where people are nicer, the air is a bit cleaner, it doesn't smell like dope on every street. So in short, Noosa is a beautiful place, and I'm very happy to be here. And I appreciate you guys for taking the time. I guess in today's presentation, I really want to touch on three key things. The first one being how we're navigating current conditions in the global equity markets and what we're doing. Second, how we stay disciplined to our investment process. And finally, share with you some insights on some of the names in the portfolio because we are finding a lot of exciting opportunities and I'd love to give you guys a taste. So the macroeconomic environment, we're paying attention to a few key things. The first one, central banks have moved into interest rate cutting part of the economic cycle, led by the Federal Reserve. That's going to have implications to broader equity markets, and we're just in the early innings of that. Second, China stimulus. Can China's stimulus measures revitalize the world's second largest economy, and what are the follow-on impacts? Third, the consumer. So as we all know, we face cost of living pressures, there's inflation more generally in the world. When do some of those pressures ease, and what can we expect to see from the consumer? Because the consumer makes a huge part of the economy, 70% of the US, in fact. On top of that, you have plenty of geopolitical events. 5th of November, there's the US elections. I'm very happy I'm not in the US for that. There's also Middle East tensions, there's Ukraine, Russia. There's plenty going on in the world, and there's plenty to pay attention to. Our message today is that we're very focused on minimizing that risk and maximizing those returns for our shareholders. And how do we do that? We stayed really disciplined to our investment process. We're focused on finding undervalued growth companies with a catalyst. Just to give you a little bit of taste, on a day-to-day basis, we conduct deep fundamental financial analysis. We go through financial filings, we go to events and presentations by our portfolio companies, attend industry conferences. So over the past year or so, we've attended over 700 meetings with companies, whether we're invested in or not invested in them. Over the last 3 months, this slide shows just some of the areas we've visited in Europe and the US. In fact, I'm actually going to go to China on Sunday, and I look forward to sharing feedback with you. I'm going to meet a broad range of companies, government officials, etc., and that's really going to help us cross-validate the information and really check that our investment thesis is occurring the way we want to and how we're positioned in the global economy. So I do want to touch on some names in the portfolio. Could I please get a show of hands of people, when they trade stocks, how many people do it through an online broker, electronically, through ComSec or what have you? If you could raise your hand if you do that when you trade stocks. Awesome. How many people call someone through voice, manually process it and settle it? There's a few here. That's about right. So 90% of the equity market is electronified. It's very easy, there's good liquidity, it's highly efficient and effective for price discovery. What's really lagged behind is the bond market. So TradeWeb and MarketAxess are two names that we own in the WG portfolio. They're two fixed income platforms that are electronifying the fixed income markets, and they are the dominant players. So as you can see on the chart, US equity markets are roughly 90% electronified. The corporate treasury market is 65% electronified. The corporate bond market is only 35 to 45% electronified. So there's plenty of runway to go. So I started my career over a decade ago. I actually worked for a fixed income asset manager, and I can tell you from experience that when they were trading, it was always through calls, through instant messages, there wasn't a clear price. There's absolutely no reason for fixed income markets to be traded that way. And we're starting to see that change. And we think it's going to be a huge structural opportunity for businesses such as TradeWeb and MarketAxess. So they're the two dominant players in the space. And to give you a sense of what it really looks like, this was the equity market pre-electronification, and this is the equity market post-electronification. So as you can see, I've exaggerated a little bit, but black and white, there's a lot of people, highly inefficient, whereas now, obviously technology, the use of people isn't as prevalent. And there's really good reasons for that. It's when you electronify, you become more efficient, you digitize manual processes, you find better liquidity pools, it's better for price discovery, and that really increases the velocity on these trading platforms. And MarketAxess and TradeWeb, What they really do is just match a buyer and seller of a fixed income security, and they just take a toll. So we can starting to see some earnings catalysts for both these names. They're both two of our top 20 holdings in the WG portfolio, and they're two names that we're quite excited about their future prospects. Now, no global equity presentation would be complete without touching on generative AI. It's by far the hottest topic in the US and probably Australia as well. And every meeting we go to with a CEO or CFO, they're asked, what are you doing about generative AI? Is it an opportunity or is it a threat to your business? And simply put, it's a technology that's too important to ignore. So how do we as a team think about generative AI? So we study past technology transformations. So it's cloud on the left, mobile in the middle, and these are all the businesses that have more than $1 billion of revenue with each of those technology transitions. You'd recognize Apple with mobile, Amazon, Microsoft, Google with the cloud transformation. And we think generative AI is still in its very early innings. You're starting to see the beneficiaries in the infrastructure layer. What that means is the data centers, the chips that are powering this technology, they're getting the capital right now. They're the scale providers. They have the big balance sheets to invest in the infrastructure. What the market is still yet confused on is who's going to win on the application layer. And we know from previous technologies that the application layer is where a lot of the value accrues to. And we believe we have a number of portfolio companies in our portfolio that are poised to benefit from that, and it's still relatively underappreciated by the market. Yes, there's a lot of hype on generative AI. Yes, everyone knows NVIDIA's stock price has gone through the moon. What we're really focused on is finding undervalued growth opportunities and ones where it might not yet be in the media or known that they're going to be generative AI winners. So one of our top portfolio holdings is SAP. SAP is a leader in enterprise application software. They're based in Germany. So they touch almost every company in the Fortune 2000. They're running their most mission-critical processes, whether it's from payroll, supply chain procurement, human capital management, Salesforce management. So they have an enterprise of applications where companies are realizing my most important data actually sits on SAP. And that's really important for generative AI. We think there are three key things that you need to nail to be successful in generative AI. One, you need high quality data. Number two, you need access to compute and large language models. And finally, you need real use applications to increase efficiency and productivity to justify the amount of capital that's being spent in that space. SAP touches all three of these layers, and they are already starting to use business AI and starting to show their customers real productivity benefits, and we are early innings in the monetization stage. SAP can, for example, if you're a company and you say, I want to reduce my CO2 emissions by 30%, how do I do that? SAP's assistant, Joule, will go through your supply chain, see where there's fat, and give you recommendations based on that. It takes away plenty of manual processes and makes your labor force a lot more productivity, and it gives SAP the benefit of being able to charge for the value that they're adding to their customers. So it's an example of a name that we really like. It's one of our top positions in the fund, and we continue to be bullish on the outlook. In fact, companies are realizing they need to modernize their back end. So we follow company earnings transcripts, and you can see that's a bottom left to top right chart. So companies are realizing, if I don't update my ERP, I'm going to be left behind. This is potentially an existential risk for my business. If everyone else is on a modern technology stack, leveraging this new technology, and I can't compete because I have too many people who are too expensive and manual processes, that's not going to cut it in this world. So that's just an interesting channel check where we really validated our thesis that we are in a cycle where companies are modernizing their systems. So hopefully that gives you just a little bit of a taste on what we look at from a global perspective. There are a number of very exciting companies across many different portfolio themes. We have digital enterprise, electronic marketplaces, innovative health, critical assets, along many others. And I'm more than happy to talk to you on any of the portfolio names. You can see some of the names below, and we're really excited about the future. We think we've stayed disciplined to our investment process. the macroeconomic environment should hopefully support small and mid caps in the future given the interest rate cutting cycle, and we're incredibly excited for the outlook. So finally, I want to thank you all for being here today. I really appreciate the time you've taken. If you are looking for global equity exposure, I hope that you'll consider WGB. And with that, I'll pass to Johnny Ayub from WAM Leaders.
And good morning, everyone. Just want to echo some of Will's comments about America. I just got back and I couldn't wait to get back on that Qantas flight home. I'll start by saying deja vu. We're living through a period of deja vu. You look at the US elections and we're going to get Trump again. We're going to have 3 or 4 years more of Trump. What does that mean? How do we play it? We're going to get radical extremes. Everyone seems to think that we can just assume what happened last time will happen again. But we're at very different scenarios between now and then. When Trump came in last time, markets were at lows. Economies were rebounding. If you look at where we are now, we're at all-time highs. Markets are slowing, economies are slowing, everything is starting to slow down. So the playbook that he once had may not necessarily mean it's the right playbook for the future. So it starts to make you wonder on what we should be doing from an investment standpoint. How do we ensure that we provide some security to the portfolio, but yet try to make some money? One of the things Will touched on is he's enjoying the options that they have in their portfolio and the wide gamut of stocks they get to pick from. In Australia, it ultimately comes down to one thing right now: banks versus resources. And that is the one question that every portfolio manager that runs Australian equities, and remembering Leaders focuses on the large cap Australian equities, the one question we're all focusing on right now is, do we hold on to banks and do we buy resources? If you look at the bank sector right now, in all of history, they've never traded as expensive. In all of history, they've never had the low amount of growth that they have going forward. CBA is trading on 3 times its book value. Banks don't trade on 3 times their book value. They should trade on 1 times their book value. But we're trading on 3 times. The dividend yield is 3%. That doesn't make anyone in this room wealthier. So the question is, what's going to make that crack? And ultimately, what's the sentiment shift that's going to make people sell their banks to buy something else? Because ultimately, what we play in is a weight of money game. What's going to shift money from one pool of assets to another pool of assets? And for us, the big shift will come is if the world believes that China, and to echo what Will was saying earlier, if the Chinese stimulus package that we're starting to hear about is going to be big enough to drive that economy back to growth and to shift the sentiment of all global investors to make them believe that we can now invest in China again. If you look at our peers in the US, China has been what they've called a widowmaker trade. Nobody's wanted to touch anything to do with China. Why? Because you lose your career. Not only your money, you lose your career. And that is prevented from people investing in the Chinese economy. We're starting to see the stepping stones right now of people coming back to investing in China. Now, the question we have to ask ourselves is, do we believe that the stimulus package that the leaders of the Chinese government, is that going to be enough? Is that going to be enough to change sentiment and then also drive that economy? So Matt Haupt, who works with us in the Leaders team, is currently in China and we're getting a live feed. So there's 2 things that need to happen to change that sentiment. We need to see stabilisation of the Chinese property market, and we need consumer spending or consumer prosperity. So the stimulus packages that need to come out need to prop up and bolster the Chinese property market, and the backbone of the Chinese economy is property. All the prosperity, all the wealth is all linked to property in that, a bit like Australia, some parallels between the two. So for us, on November the 8th, and ironically the timing of that stimulus is after Trump gets elected, and I keep referring because Trump will be elected. They've delayed the stimulus till after the US election because they realise that under Trump economics or Trump policies, there'll be tariffs, there'll be trade wars, there'll be all that forgive me, I'll say it, crap that we saw for years, that will all come back. But China are ready for it. So to go back to that earlier comment about deja vu, we may not see the same playbook because China are going to anticipate what we're going to see. So their stimulus will be double the size if Trump gets in versus if Kamala was going to be voted in. So they're ready. Now, will it be a one-time bazooka policy change which changes the mindset of the consumer in China? Probably not. It's going to take 3 or 4 or 5 iterations. Equally, shifting the sentiment of investors is not going to be a 1 or 2 week process. It's going to take months and months and months, possibly a year. In Leaders, we believe that that sentiment shift will take place. We believe that the stimulus package that China will put into place will be enough to drive that economy for the better part of a year or 2. Beyond that, we're not even going to think about. We're not even going to guess. So for us, we believe that the names on this chart here are the names that are going to lead our portfolio for the next year. We believe that banks will go through a tough period. They are too expensive. It's very difficult to build an investment case to justify their valuations. There is nothing wrong with CBA. There is nothing wrong with NAB or Westpac. There is something wrong with ANZ, but we can talk about that one later. Their results next week will be fine. You know, they'll hit market expectations and all that other stuff, but they're just too expensive. Yet these are the things that we think, and for all their various reasons, will do particularly well. The other leg is how do we get exposure to the Chinese consumer? The Chinese consumer, you know, it's new cars, which is aluminium, which is South 32. It's also entertainment. It's going out to dinners. It's buying more wine, which is Treasury wine. These are the things I think are setting up very well for a rosy 1 to 2 years. You know, BHP, Rio Tinto. You know, the question not too long ago was, will iron ore stay at $90? Will it stay at? Would it go to $60? Well, given Chinese stimulus, the question now is, does it go to $120? Does it go to $150? In any event, their dividend's going to be safe. They're going to have good growth, and they're cheap. We like that. We like that equation. So for us, Fortescue, Rio, Iluka, all those names on that board, for various reasons, we really like. And we think the rotation that will take place from banks towards resources will happen over the next year. But remember, we are at all-time highs. So we have taken a cautious view towards the economy. We have taken a cautious view towards markets. If you look at what we're living through right now, it's AGM season, and companies are starting to come out with their trading updates. Things are slowing down. Even really safe defensive companies like Wesfarmers are showing cracks. Which, you know, if this is the start of the recession that we're likely to have, not using Paul Keating's words, the recession we have to have, but the one that we're likely to have. If you look at New Zealand as a prelude to what potentially could happen to Australia, that was a very deep recession in New Zealand. Their economy is really struggling. But you come out the other side, and the stocks that will do well are those classic industrials with good fundamentals, and that's what we like. And if I go to the next slide, and I'm getting the countdown here, that gives you a bit of a framework on the stocks that we're positioning the portfolio for. It gives you a theme and a taste of what we like in markets. You know, on the far left, and I talked about sentiment quickly, you know, a year ago we spoke about Qantas, and everyone hated Qantas a year ago. Why? Because Alan Joyce was selling stock and all sorts of stuff. We took that opportunity to buy a lot of Qantas, and we've done particularly well for shareholders out of that investment. On the opposite end of the spectrum, Coles and Woolworths are going through that sentiment shift right now. They're the ones feeling the pressure. So from our perspective, we think that if we look forward a year, these are opportunities. So that bottom, from where you're sitting, bottom right, they're the names that we think have fundamental qualities that we like, that have just some short-term sentiment issues. So they're the stocks that we really like we're buying today. The top right we've spoken about, and that bottom left are a lot of the positions that are core within the portfolio. I think I've run out of time on that, so I'm getting the wind up, but thank you. I'll now pass over to Will Thompson, who can talk about WAM Capital and WAM Microcap. Cheers.
Thanks, Johnny. You're all lucky enough that I'm wearing a suit today. On Sunday, I'll be in a tri-suit doing the triathlon. You'll see me in my Wilson Asset Management triathlon suit, so look out for me. Here representing WAM Capital, WAM Microcap, WAM Research and WAM Active today. So I thought I'd start with a question, a little quiz, if I can get this moving. There we go. Go back one, sorry. So what do these four things have in common? Fisher and Paykel, Russell Crowe, Xero, and Mainfreight. New Zealand, yep. There's a little technicality, but we all claim that they're Australian. So you can see the charts here. These are what I call 30 baggers, which means they've done 30 times their share price from, as about the start of 2011 I checked from. They've outperformed the market 28 times. So we love New Zealand companies, and there's a few things within the New Zealand economy that makes it a really good area to start a business and set them up globally. The first is it's quite diverse on an economic standpoint in terms of the wealth gap between the high and the low end, and also the ethnicity too. And it's also a market where you don't have a lot of global challenges coming in. You don't ever see a US company, the ones that we'll talk to, they want to expand from the US to Europe. You don't ever hear them going, we're going to expand to New Zealand. They're always going to everywhere else. So it's a place where if you really want to start a business, and a global business, it's a really good, if you want to offer a product and service, it has to adhere and it has to offer something to a lot of people and a wide range of people. So as Johnny mentioned just before, the New Zealand economy has been nothing short of atrocious. And part of that was because they had rampant inflation, as we've all felt throughout the last few years, but they were the first to hike rates, and they went really aggressive on the rate hiking in October 2021. Since that point, they've kept them high, and probably they kept them too high for too long, and you've only just started to see them cut rates. In the past 18 months, we've been to New Zealand as a team 3 times. The first time we went over there, we owned 10% of a company called THL, which is a camper van company, and we decided to sell our shares because we realised how bad it was going to get. That ended up being a prudent decision because the share price did roll off pretty hard after that point. And we went back, it was about 6 months ago now, and it still felt a little bit bad. However, when we chatted to the management teams, we meet with probably 20 different companies every time we go to New Zealand. When we chatted to the management teams, they were really happy with the new change of government. They thought that the interest rates were about to be cut, and they said, we're not saying things are getting better, but it's not getting worse. We went last month, and it's getting a little bit better. And we think this is a great time to buy New Zealand stocks because no one else is. Everyone's still worried. Everyone's reading the headline, the New Zealand economy is going horribly, and this is what we think. It is the return of New Zealand economy. It's a great time to buy New Zealand stocks because their earnings are troughing, and we think from this point onwards they're going to increase. So I'll touch on one of my favourite stocks called Mainfreight. So that book there is called Ready, Fire, Aim, and I highly recommend you read it. It's one of the best books I've read this year, and it's about how the company was started. So Bruce Placid started it in 1977. So in 1977, New Zealand had a couple of interesting things. It wouldn't have been a great time to start a transport company. The first one was if you wanted to transport a good over 40 kilometres, you had to use the National Rail. The second one was there was essentially a price-fixing cartel run by 4 Australian companies that were running the whole transport system. He was working for one of those companies, and he looked at it and he said, they are offering a horrible service at a horrible price to our customers. So he started one little branch in Auckland and expanded to 3, then 6, and the big cartel started to take notice. So what did the cartel do? They dropped their prices below where they were making a profit. And 50% of Bruce's customers left that day. What did Bruce do? He put up his prices because he knew that every single one of those customers would come back for the superior service, and they did. So in that period, the way that he ran the business was every different branch had their own profit and loss, their own management team, and everyone within the business, from the forklift driver all the way to the manager, was incentivised by that profit and loss. And every Saturday morning, Bruce would call every single manager and ask where the profit and loss was for that week and what he was seeing and what they were doing. They never had any forecasts. They just ran week to week. The business is still run the way that it is today. So they've now got operations in New Zealand, Australia, Europe, and they've just started expanding to the US. The reason we're buying it at the moment is because their New Zealand earnings were down 40% from last year. but we think they're going to be able to improve and increase from this point onwards. There's also a really good US expansion story. So within this business, we get exposure to the New Zealand economy, which is troughing, and the American economy, which is still going really well. There are some interesting dynamics within it, which John and both Will have talked about. But this is a growing company who are expanding. Throughout history, and you read this in the book, they do their best expanding when the economy is not going well, because that's when their competition are taking back investment. They're a profitable business, and they're using this opportunity to keep expanding. So these are some of the businesses that in our portfolio that we hold. A2, you'd recognise, that's one that we think will be really, is exposed to the Chinese consumer. We think it's going to go really well. SmartPay, THL, Steel and Tube, they're all the New Zealand Stock Exchange as well. They're all businesses we really like and hold within each of those 4 portfolios I brought up earlier. And to finish, I hope that you sort of learnt today the way that we invest. We go out, we talk to management, we do lots of travel, we go on the ground, we talk to competitors. And we're really trying to find a company that we think we can see the earnings growth and catalysts for that earnings growth. So it's been a pretty tough market for small caps. You've seen the broader market accelerate, and small caps have been at a bit of a discount over the last 3 years. And we think those headwinds, which have been interest rates and the economy, are going to start to turn into tailwinds. The smaller businesses are really exposed to interest rates. And as we've seen interest rates start to come off in the US, we've seen in New Zealand. We think Australia is going to take a little bit longer at some stage next year, but we think this sets up as a great opportunity for small caps to really outperform over the next period. Thanks for the time today, and please come and ask any questions or talk about anything. I'm always happy to chat. Thank you.
Introducing WAM Alternative Assets, the only listed investment company on the ASX that offers retail investors access to a diversified portfolio of alternative assets such as private equity, infrastructure, real estate, private debt, and real assets. Let's take a look at some of our investments. Darwin Airport is the busiest airport serving the Northern Territory. It consists of an international, domestic, and cargo terminal. Nericon Citrus is a 516-hectare citrus farm located near Griffith, New South Wales. Plantings consist of a mix of citrus, juicing citrus, mandarins, wine grapes, and lemons across 3 allotments. The Somerset Specialist Centre provides leading medical accommodation to specialists and allied healthcare practitioners. The facility is anchored by cancer care provider Genesis Care and medical imaging and radiology provider Q-Scan. Ross River Solar Farm is located in Queensland near Townsville. Built on a 202-hectare site, the solar farm generates renewable energy to power 54,000 homes. Adding alternative assets to your investment portfolio provides many benefits to shareholders, including lower volatility of investment returns, a broader opportunity set, long-term investment horizon, returns driven by both capital growth and income, and more consistent returns across economic cycles. To find out more, visit wilsonassetmanagement.com.au.
Thank you. Good morning, everyone. My name is Dania Zinurova, and I'm Portfolio Manager of WAM Alternative Assets. Just exactly the same listed investment company as all our other LICs. The main difference of WAM Alternative Assets is that it invests in assets and businesses that are not listed on ASX. They are privately owned assets and businesses. I'm going to test you to see if you remember from my last presentation the 2 examples I gave you of the assets where we invest here in Noosa. Sunshine Coast Airport, yes. And one more? Where actually the first store was opened here in Noosa? No? Yes! Okay, so that's great. You do listen, you do remember what I say. So these are the examples, and I always like giving examples when we do this type of roadshows. Think, what are the assets and what are the businesses where WAM Alternative Assets has exposure to? And two great examples, Sunshine Coast Airport and Betty's Burgers, very different businesses, different returns and risk profiles, and I'll tell you more about this. What we are doing with WMA, we are really providing access to you, to our shareholders, and to the broader market, to those investments that historically, and even now, they are not really accessible or easily accessible for various reasons. And Jeff is really a visionary. When more than 4 years ago, he started looking at those strategies and realizing that within our shareholder base, there are very few opportunities how we can give this access, how investors can invest. Why? Because think about Sunshine Coast Airport, and I don't know if any of you would be able to participate in the equity ownership of an airport. The minimum investment ticket sizes are really large. They often start from 5 million, 10, 15 or more. They are long-term investments. In other words, we can't just trade in and out on a daily basis of those assets and businesses. They require a lot of expertise, technical expertise. And those deals and those transactions, they don't come to the public market. So it's a lot about the network and a lot about being able to access those deals. We do know, I'm sure you know as well, all the large institutional investors, they've been investing in those asset classes for years. And Australian super funds, they've been the most active ones globally. Most of them would have up to 30%, future fund 50% in this type of assets. Why? Because they bring a lot of complementary benefits to any portfolios. And I personally, I spent most of my career, over 20 years, investing on behalf of institutional capital, and I don't see any reasons why other investors and our shareholders should not be accessing those opportunities. They do bring strong diversification benefits. They do provide link to inflation and provide good risk protection in the environment when interest rates are rising. And the listed investment company is really unique and the most suitable structure for our shareholders because it's liquid, you can trade in and out. It does pay fully franked dividends, but it also has the potential, based on the characteristics of the portfolio, provide really attractive, outsized returns. And I'll give you examples to demonstrate how it's being done within the portfolio. One interesting feature is that we think about the investable universe in Australia, and we often focus on the listed equity markets. And most of you would know it's the largest in terms of the size. However, when we look at the number of the companies listed on ASX, it's about 2,100 as of June, compared to the number of private companies registered in Australia as of the same date, 2.6 million. So the universe and the opportunity set is really enormous. And it would be an unrealistic expectation for me to go and meet every privately held company and do due diligence on all of them. It would be not really possible. So what I like doing is implementing or using several lenses in my investment strategy and when I think about the portfolio construction. And because we are talking most of the time about the assets that we are going to hold longer term, 3, 5, 7 years, some of them even longer, I do like to think about this universe in terms of the themes, investment themes, that are underpinned by strong long-term tailwinds. And you won't be surprised seeing those 4. We talk about them a lot. I'm sure you hear about those themes at other conferences and read in research papers. But those are the main ones where we can look at climate change or energy transition, and we can select opportunities either in infrastructure, private equity, even in some agriculture investments would qualify for the energy transition. In terms of the growing demand for food, we know global population continues growing. We are talking about limited resources such as farmland and water available for irrigation. So the underlying fundamentals in those sectors, they're really strong. And again, the investment opportunities can be across asset classes, not just in private equity and not just in real estate or infrastructure. Similar to digitalization, growing aging population. And I just earlier this week attended an AGM where I heard from the CEOs of the companies, Advara Heartcare, Retail Zoo, and few others, where they provided update to investors on the progress that they've made over the last 12 months since the investment was made. And I was really surprised to hear that Advara Heartcare, which is, I thought, was the leading Australian cardiology service providers. They have around 400 clinics in Australia. They're apparently globally leading cardiology service providers. So really the expansion strategy for them is not just in Australia, but also global. And I'll tell you some examples on the Retail Zoo. I did want to focus today a bit more on the themes such as growing demand for food and give you some examples, what we've done within the portfolio, within this theme. But I also wanted to note that based on this approach, we can narrow our investable universe. And on average, we would have approximately 100, 120 opportunities that come to our desk. And out of this number, we would only really look in more details at 10 to 15, and as a result would invest only in 3 to 5 investments a year. So very different dynamic within the portfolio. Why? Because usually due diligence, investment due diligence, operational due diligence does take a lot of time. And on average, we would spend around 3 months just doing this work on one transaction, on one deal. Again, because we want to make sure before we commit long term, we do a lot of work on the risk assessment, on the opportunities for the future capital growth. Let me ask you a question. I don't know if you would know. Let's see. But what do you think, or how much do you think an average Australian family with 2 kids currently spends on grocery shopping? Per week, sorry. 350. That's a bit closer to my family, but it's about 200, 220, according to the latest numbers that I found. And if we look at the last year, it's actually a 6% increase. So if we think about the inflation, and the latest inflation numbers were out, so we know that inflation has been slowing down. These are just headline numbers. Those numbers don't really give us the full picture. But if we look at historically what has been the dynamic of the inflation for food and non-alcoholic beverages in Australia, it's been actually increasing over time. And my expectation and my view based on the research and the analysis, I don't expect it will slow down. So my thesis on this theme is that I want to continue finding opportunities in this theme because the sector fundamentals will continue remaining strong. Even just looking at factors such as value of farmland, in Australia, the value of farmland increased by nearly 200% over the last decade. Now, if we look at the values of water rights, it increased by 150% over the last 10 years, and it will continue increasing, in particular if we take into account what's been happening globally with geopolitics, what's happening with labor, etc., etc. How can we invest as an investment team in this theme? There are different opportunities. Again, we're looking at a huge investable universe. We can invest in agriculture, we can invest in water rights, infrastructure, or we can invest in food-related businesses via private equity strategies. So Betty's Burgers is a great example, and I like choosing it because the first store is opened here in Noosa. Now, Betty's Burgers and Boost Juice, the two companies that I owned by a larger consumer goods company called Retail Zoo. The way private equity works is when an investor comes and acquires a majority stake in the Retail Zoo business, in this case it was 80% of the Retail Zoo business, it's not just about providing private capital, it's also about providing the expertise, bringing the new management team. They just hired a new CEO who is an ex-Starbucks CEO, and he's joining in November to implement the strategy. It's about looking at operational efficiencies, growth. Over the last 12 months, they opened 13 new stores, so the number of the stores now is 67 across Australia, and the growth trajectory will continue. They apparently just revised their menu, so please go and check, better menu. They revised their packaging, etc., etc. So there is a lot of work. It's really an active ownership when it comes to private equity type of strategies. What do I expect from this? I expect that we will hold this for another 3 to 4 years before the business would be considered matured, before we reach the target returns. When we talk about the target returns, we talk generally about 3.5 to 4.5 times money invested over the period of time. And then this business will be sold. This business will be sold either to another private equity owner or a global consumer goods company. And that was a good example of Birch & White. That was a recent exit within WMA portfolio. We invested back in 2017 in this business. It's an Australian-based business that produces sauces, mayonnaise, tomato sauce, etc. And it's a very popular business that services food retailers, supermarkets, etc. The business was sold to another private equity investor, and when we look at the measure of the return versus our NTA, it delivered 105% premium to December carrying value. So that's a pretty good result in this challenging macroeconomic environment. But this is, in a nutshell, WMA. The portfolio continues evolving, and my expectation is that the easing monetary policy that we expect will really help us to continue delivering strong investment returns for our shareholders. Thank you.
Thanks, Lynn. I'll get the investment team back up on stage, and we'll go through the Q&A section now. Boys, Will? Yeah, in the middle. Go in the middle. Go in the middle. Does everyone want to stand up and stretch your legs a little bit? You've been sitting down for an hour now. Give yourself a... I don't know if I went for a walk this morning. I'm a bit sore, so if you guys are too, stretch off a little bit. I am, and I must apologise, even if you don't read Will's book recommendation, you will now see main freight trucks wherever you go. And I saw one here in Peppers yesterday after we did the presentation before, so you'll see them everywhere now. We've got 2 mics. We've got Tommy and Bridget on the mics, Roman. So if anyone's got any questions, just feel free to pop your hands up and we'll come and find you. And if you just leave your hands up a little bit, we'll make sure kind of the next question's ready to go. So is that a question up the back? Yeah, right up the back there, Bridget. Anybody else on this side got a question just for next up while we're waiting? No questions today, this will be quick.
Must have been good presentations.
Good morning. A quick question from one of the early presenters. You seem extremely confident that Donald Trump will win the US election. Yet all the political pundits are calling it line ball. and a lot of your investment thesis seems to be based around that outcome. Why are you so confident?
On the ground in the US, and Will probably can answer this, it's pretty definitive that Trump is going to win over there. Kamala has lost a lot of the support of the middle and even around her constituents on the West Coast and East Coast. So on the ground feedback, and from most people in money markets, is that Trump is by far and away the winner here. As to your second question, it doesn't really make a difference if it's Kamala or Trump from our investment case. China stimulus is still China stimulus, and it's going to come in one way or another. If Kamala gets in, there will be less likelihood of trade wars, and China will revert to historic practices where they become more of an export regime as opposed to a domestic consumer-facing regime. So for us, it's actually better if Kamala gets in, because if China becomes an exporter again, and the trade wars and the threats of tariffs and the like gets diminished, China's return to its strength and its targeted 5 to 6% GDP growth is a lot easier for them to achieve, which actually bodes very well from an Australia standpoint. Secondly, you're less likelihood of seeing inflationary measures come through, as a lot of that globalism and patriotism. So globalism comes back and that patriotism and nationalism disappears a little bit. So from that standpoint, we'd actually welcome Kamala to come in, because it's more of what we've seen. And from an Australian regime, it's less for us to think about, to be frank. But we just know under Trump and the likelihood of him coming in, that we're going to be better prepared this time around. And we need to be prepared if he gets in for the irrational statements and the illogical moves that he'll take. There will be some more responses that people can do. So from that standpoint, from the investment portfolio, we got to be prepared for Trump, but we'd be more than welcoming of the other party getting in.
Yeah, I'd echo Johnny's thoughts. I think it doesn't really matter who wins. I think each, depending on who wins, like each has different policy, and you adjust the portfolio based on the policy. So Trump's big policy has been tariffs, so we're really cognizant of that in our portfolio companies. Who has supply chains in China, who are potentially going to be outcompeted, who has to bring their manufacturing back to the US. They're the different fundamentals that we probably pay a little bit closer attention to. In terms of the portfolio, it doesn't matter if Kamala wins or Trump wins, we're positioned for either scenario.
I think potentially it will with Trump. I mean, my view is why we are all so confident it would be Trump, because he also has been more successful attracting large donors. So even when you read the reports of Elon Musk, paying, what is he doing now? Paying $1 million
to vote and to sign up.
to vote. So he definitely attracted more capital flows. But I think in terms of the changes within the sectors, potentially his election would lead to demilitarization. So, some impact on defense sector globally, and as a result on resources. But that's a long shot, because it's not just up to him.
Just an unrelated follow-up question. Any comments regarding Star Entertainment? Is that still held, and what's your position on that?
I was waiting for this question. Without question, the worst investment that the Leaders team has ever made, or will ever make, to be blunt. We completely misunderstood the decline in revenue, the costs associated with transformation or remediation. So where we sit today is there's a business which, under Steve McCann, has and will retain its licenses. That is what we do know. What they need to do, the next steps for that business to transform is implement a cost-out strategy which makes the business economical going forward. So if you look at where they stand today, the big thing that needs to take place is there needs to be a levelling of the playing field. And what we mean by that is, how can you walk into a casino and everything needs to be mandated carded play, but you can walk into a pub and just put your $1,000 into a machine, nobody's going to check. If you look at the total gaming revenue that's transpired across Queensland and New South Wales, there hasn't been that material step change. The politicians, they will turn a blind eye to money that's going into clubs and pubs, but they have taken a sharp knife to the casinos. So basically all that money laundering that was taking place in the casinos and now is taking place in clubs and pubs. So all they've done is shift one problem from the left hand to the right hand. So you've got the cleanest gaming in the country sitting in Star Entertainment's precincts in Sydney and in Queensland. But that doesn't help us as investors because what we're facing is 20% lower revenue and 40% higher costs. So they need to get their cost base under control, and Steve's going to do that over the next 6 months. Ultimately, what it's going to come down to is what we can get for the assets because as we stand today, the business isn't, it needs scale, it needs bigger pockets, it needs reinvestment, and that's not what shareholders aren't willing to do that. So we've been working with the company. Yes, we have a shareholding in it, but it is smaller today than what it was once was. We've had to take a bit of pain on that one, unfortunately. But where it stands is that you've got a Queensland asset. The two Queensland assets in particular, the Gold Coast asset is very saleable. It's freehold land, has opportunity to build 3 more towers on it, be it residential or hotel or whatever it might be. Someone will buy that. The Sydney asset logically should be held by the Crown, the Blackstone Group. So how that happens, who knows? And then working through the Brisbane asset, and I'm not sure, has anyone been to the new Brisbane casino? There's a lot of teething issues because they were forced to open it pretty early. But that is a wonderful asset, just opened 1 year too soon. And the next owner will do very well out of it. Just that question is what we do between now and then. So from an asset base, it's worth $2.5 billion. The company's trading at 700 mil and it's got about $1 billion worth of liabilities. So, it's just trying to realise that asset value and it's going to take a bit of time.
I've got a couple of questions. Regarding banks, I see Macquarie's having a bad day, but in fact, it's quite separate from the retail banks, I assume. Second question really for Dania. We've seen in the past, a stream of new companies coming on with IPOs. Do you see that trend becoming less over time because managers want to avoid disclosures and so on? Just curious to what your view is there. Thank you.
Do you want to? You go first, I'll go second.
You
go first.
Yeah, thank you. So once we see the equity markets are being challenged by the heightened volatility and uncertainty, we call that period in private markets that IPO window is being closed. So there are less opportunities for investments that would qualify as pre-IPO, where you as an investor would buy equity in a privately owned company, but with a view then to exit or realize your investments through an IPO. And this type of strategies, they are more common in venture capital type of sector. The answer to your question is absolutely. We saw the IPO window closing completely and it hasn't really reopened yet. I mean, we talked about this, like slowly.
You're seeing I think there's an IPO next week or in 2 weeks.
Yeah.
It's
It's been really very slow environment compared to 3-4 years ago. The question whether fund managers or management teams are avoiding this in order to avoid information disclosure, my view is that that's not the main reason. It's true that to go through IPO, there is a lot of preparation, usually requires 6 to 9 months preparation. The reporting regulatory requirements are very rigorous, so there is a lot of work goes into this. But it really comes down to what's the actual upside going through IPO and the timing of doing that IPO. What we saw on the other hand in private equity over the last 2 years, that there are more transactions where public companies are taken private. So, for example, in the US, Will is based there, he'll confirm, but in the US, about 70% of all M&As within private equity, they were public to private over the last 12 months. In Australia, given different listed equity markets compared to the US, we only saw a couple of those. We had some great examples in WMA portfolio, Slayton Gordon, Quantum IP, Norton, where private equity investors believed the valuations were relatively attractive for those listed businesses, and they required more long-term patient capital, and there was an opportunity to take those companies private. So the reverse is happening more now, probably. Sorry for the long answer.
I think also just on the IPO, there's a lot of different reasons to IPO as well, and I feel like we're going to start to see them all come back to the market as well, because there are lots of positives to being listed on the market, including businesses like the ones referred to earlier. They're all founder-led, and all the founders still own, like in Mainfreight, I think it's 30%, but they were 60% at some stage. So they need to crystallise some of the money they've put into starting these businesses as well. And we love founder-led businesses. We'd prefer them to be more founder-led businesses on the ASX, where they are selling a little bit of money to the equity markets, and we get an opportunity to invest in these high-quality businesses where the founder's still the manager. Just
on Macquarie, so the results came out today, so they did their annual results this morning. Macquarie, over the last 3 years, their earnings have been bolstered a lot by commodity trading. So it's not something you really associate with a bank, but commodity trading has been the backbone of that company, in particular when there's oil volatility, because they own a lot of the infrastructure in the US. So when oil price fluctuates materially, they make a lot of super profits by holding on and trading that. And there was one particular person who ran that business who made a hell of a lot of money for him, who's no longer there. So the result today demonstrate a normalisation of the volatility in that side of the business. Microcap, which is their traditional business, what we all know from the investment bank standpoint, is doing quite well. And their other part of the business, which is their co-investment, that's starting to do pretty well too. So we don't own it. I've been ducking in and out over the last 15 minutes buying some shares in that one. So if you want to know some real-time feedback, that's what we've been doing this morning. And I've been a guy text message because Matt's in China. I'm trying to do the two things at once, but that's a little bit of context around that. We're having a small little position which we've avoided for some time. So it's starting to look a little bit more interesting. I'll just add one little thing on IPOs. One thing that we've noticed particularly over the last 5 years, given the duration of markets has shortened, so everyone's time frame used to be a year or two, it's now weeks or months. It's terrible out there because there's more and more short-term money managers in the market really focusing on gyrations and momentum and stuff like that, which provides opportunities for PE in particular, where if they have the willingness to take a 1 to 2 to 3 year view on a company that equity markets aren't particularly fond of, they'll go and buy these things, because turning around a company in the market's eye is very difficult today, because everything that is being said is being absolutely scrutinised. If you're not getting it on day one, people don't have the patience for it. So it's providing a lot of opportunity to the larger pools of capital that we're seeing in PE. So from that standpoint, one of our processes is that trying to identify these assets that private equity will be attracted to. So Aurora was an investment position that we've spoken to for some time. That was completely undervalued by the market, still undervalued by the market, but PE would come along and pick off individual assets within portfolio because they know they can actually turn it around away from that public scrutiny, which is what you might have been referring to around, disclosure may not necessarily be their focus because they want to turn something around, remove headcount, whatever it might be, without getting the politicisation of it.
In the middle here, thank you, sir.
I've got 3 investments with Wilson, and my worst performance by far is WAM Research, and both price-wise and loss of franking credits. Could I hear a bit of something about? I don't often hear much spoken about WAM Research. Are they going to come good, or what's happening with them?
Yeah, maybe I'll start.
Can I join the audience?
Yeah. Maybe I'll start that one, we'll pass to Will. I think if you take a step back and you look at probably the LIC sector as a whole, when interest rates were low or zero, investor behaviour changed. Investors sought yield, and high yield and equity products like LICs were desirable because of the consistent income they could produce. With WAM Research and WAM Capital as well, I'm sure there's similar questions in the audience with WAM Capital and investors that hold that. Those stocks were bid up aggressively. If we go back to early 2022, WAM Capital was trading at a 30% premium to its NTA. WAM Research was trading at a 60% premium to its NTA. So it's like you going in and buying a car worth 30 grand and offering to buy it for 50 grand. So your share price within WAM Capital was extremely overinflated. And what we've seen more recently is as interest rates have risen in the LIC sector, investor behavior has rightly changed. You know, investors have got a viable alternate. Investors have reduced their exposure to yielding equity-like products and increased their exposure to cash and cash equivalents. And how that's transpired in the LIC sector is companies that were at unsustainably large and worrying premiums like WAM Research have been sold off back to NTA parity, and others that were trading around NTA parity are now trading at a discount. You know, for us, it's one of the, being able to buy, and Jeff always says, you know, being able to buy an asset, $1 of assets for 80 cents is the holy grail of the LIC sector. On the other side, being able to sell something for 60% of what it's worth is equally as opportunistic and fantastic. But I think investors get, and maybe rightly, anchored to the highs of the share price. But the dynamic there is, you know, WAM Research was, as I've hopefully highlighted, extremely expensive, artificially inflated. The investment team have done a phenomenal job, in particular over the last 12 months. So I guess from where we sit today, and I guess to finish off your question on will it come good, WAM Research today is trading at a very small premium to its NTA, so it's fair valued. If you look at where it's traded historically, it's cheap. Maybe on the kind of the prospects of performance.
Yeah, well, I think it was our best performing portfolio in terms of investment return from the portfolio level, if I'm not including the share price. And from an investment team, often the best reflection of your portfolio is the one you have to spend the least time on because it means it's got the least issues. And WAM Research it's a great portfolio because it really is a deep diving research portfolio where we spend a lot of time with company management and spend a lot of time looking at the financials and make really long-term decisions. The stocks in that portfolio, it has a much lower turnover than the others, and the stocks in that portfolio have generally been there for a while. If I think about, I think the top stock in there at the moment is Tuas Group, which is it's a business that was started by the founders of TPG Telecom. They went over to Singapore and realised there was a big gap in the market to start a telecommunications company that was at the value end, so at the lower end, because most people in Singapore actually have 2 SIM cards in their phone. And that one is for your internet usage, which is what Tuas are offering, and a lot of people in Singapore are expats, so that one is probably more to communicate with your friends and family overseas. These guys are freaks at managing like a telecom business, and they've done it before, and they're now expanding almost globally. Yesterday, they've come out with a new product. It's called an eSIM, where you can essentially sign up and get a SIM card anywhere you want to go. A lot of these businesses, this is where Main Freight sits within this portfolio. The research portfolio, has performed really well. I think it's up 15% year to date and was up 31% last year. So we're really proud of that performance because it has been a pretty interesting period for small caps where, as you saw from the chart before, small caps have been hard. So you've really had to make sure your stock picking was good, and we've been really happy with how that performance is, and we're pretty optimistic with how it's going to go from this point onwards, and we hope that the share price will reflect that.
Thanks, Will. Yep. Thank you.
Probably to Dania, just in relation to health investment, there are heart care. Most of us in the room probably have heart issues. Particularly with the shares.
Hopefully not.
I'm more concerned about investment in aged care facilities because that's the one, it becomes political. They could change the regime very quickly, and wages are the absolute killer there, and we're all living older. How big of an investment are we going to go down this track? As I said, I want growth in my WAM shares.
Yeah.
And I have real concerns if we continue down this line.
Yes, thank you. So we don't have any investments in aged care facilities. There is an investment in a business called Aged Care Decisions. That's a digital platform. So it's more of a digital private equity investment. Digital platform business that connects families looking for aged care service providers and registered aged care service providers who pay fees to the platform to connect to end users. So that's more of a, I'm with you absolutely, and I've seen in the past in Australia and globally a lot of aged care operators facing significant challenges and disappearing from the market. It's a very difficult business to operate from reputational risk perspective, staff shortages and other issues. However, the theme is very strong. So I was looking for opportunities to still get exposure to the theme without getting exposure to the operational side of this type of businesses. So it's a very simple business and really based more on scale. There are lots of families who just do the research themselves and they go to ACD to find those providers and do the due diligence on those providers and basically just generate subscription fees as a business.
Maybe I'll touch on aged care because we do have a position in WAM Capital and WAM Micro, which is Regis, and we're substantial in it. So we'll probably take a little bit of the opposing view because we do think there's going to be a lot of demand for aged care. And you're right that there's government stimulus which may or may not be there year to year depending on the government, but it's going to be very difficult to take it away when there is an ageing population. The way that we've got exposure is through Regis, which we, as a premium operator. So there's a co-contribution that everyone has to make, which is funded by the person who is there. And we think that sets up for an operation where they can make a lot more money per person, but also offer a better service per person as well, where the actual person who is in aged care feels like they're being looked after, as opposed to where it's solely government funded. Yeah.
No, I was just going to say that childcare is obviously a very similar.
Well, childcare is very similar, and at the moment you've got the Labor government saying that they're going to fully fund childcare. We've owned GEM, which is G8 Education, and it's been a really interesting investment. I think I've met with management, I would say, north of 10 times in the past year because they keep doing little conferences and we listen to calls and so. And it's been a really interesting dynamic because originally they thought that occupancy was starting to increase and it actually came back a little bit. The share price hasn't gone as well as we expected a year ago. It's had really good performance the last couple of months. And occupancy was down because the families who were using the childcare worked out that it was actually cheaper to have one parent not working rather than have to pay that parent's daily wage to take them to childcare. So this is changing because it is getting a little bit, cost of living has been an impact, but as you get more of a contribution from the government, which we're not actually locking into our portfolio, when we do our model, we don't use government funding as a big source. We kind of see that as a little added benefit. We look at it based on, okay, what do we think a parent can do? And I'm not a parent. Maybe the parents in the room can talk about it. Like, it's a real decision you have to make. So again, we go to the operator where we think are managed really well, which we think GEM are, G8, and ones which have good locations, and ones who are rational with the decisions. Like, part of we've met with G8 multiple times a year for the last 10 years, and it hasn't been a suitable investment. Every time we meet it, we think...
And cost more than private.
Yeah, and cost... Yes, exactly. Yes. It's expensive.
It's very expensive.
However, when we've met with... when the new manager came in, he said, there's about 5 of these assets that we own that are losing so much money, it's such a drag on the rest of our business. I'm just going to get rid of them. I'll actually pay to get rid of them because you watch how we make so much more money on the ones that are going well. And so he's rationalised the asset base, and investors are just starting to wake up to that. And in a period where now parents are going, you know what, childcare may be less next year, I can go back to work, I can send my child to childcare, and I can work and I get a little bit more income from the family. So we think it's a good dynamic for that. But it is like, it's not for the faint-hearted when you're going into aged care and childcare because there are government issues. So the most important thing comes back to our investment thesis, our investment portfolio, and the way that we invest is we've got to make sure we're paying the right price for that business at the start. We don't want to be paying a lofty valuation because there's so much more risk. So we made sure when we bought it, we were buying it under $1 per share, and I think it's trading $1.40 at the moment. So we're really happy with how that's been going.
Perfect. Oh yeah, thank you, sir.
First of all, thanks for sharing all of your views today. I'd like to go back to the small caps topic. And as you showed, there was a divergence from the ordinaries. And was that in 22 or something like that?
It was from, start of about 21, I think it was. 21 to 2, yes.
And we heard numerous times that small caps were ready to roar. They haven't. And so WAM Capital and other of your LICs are focused in that area, which probably is hardship now. You're waiting for the turnaround. What will be the catalyst?
So it's I wish I knew it, to be honest. I don't exactly know, but so we've actually performed really well in this period, and it's because of our stock selection. So if we were to buy the broad-based small cap sector, it would have been pretty tough, and performance would have been pretty tough. So what we're picking on good quality companies with good management teams we think could outperform during that period. So something like Tuas Group, which I referred to earlier, which has been outperforming in a market that's been declining. So what we're actually looking at now is probably more of your cyclical companies that earnings have really been struggling. So companies where they have faced economic headwinds because their interest costs, they were paying 4% 5 years ago, they're paying 8% today. That's a big impact to your NPAT and bottom line and your earnings per share, which really restricts the amount of money you can invest back into your business. You've also had inflationary costs, so the cost of goods for your products has been going up. So in that environment, we've been cautious about what stocks we select. We had an update from Universal Stores yesterday, which I think there's a store, I'm not sure if there's a store in Noosa actually, there's one in their area, which is actually a Queensland-run business. And it's kind of like what General Pants used to be, but a lot cooler. And so this is for a young 20, probably less than 25-year-old, and they want to wear Crocs. They want to wear jorts, which are jean shorts, which were cool when I was 10, which was 20 years ago. Everything's coming back in fashion. It's kind of like the fluoros and all that stuff. And they knew that their customer was struggling, and that knew that they had higher rent charges, and they knew that they weren't getting every single shift at the pub. They were getting less shifts. So this was a company that we picked that would go, well, actually, I think this can outperform in a bad economy. Whereas now we're looking at companies which are like, okay, what's a company that we think can outperform when the economy starts to return, when interest rates start to return? So a couple of those, and that's why we brought up New Zealand, is steel and tube, New Zealand-based steel and tube business. There's New Zealand Stock Exchange. The volumes in the New Zealand Stock Exchange have been horrific. They've also got this wealth management business which isn't earning money, and that's starting to turn. So these are just little cyclical things that we think are really, like the headwinds that they've faced are going to turn into tailwinds, and we have to be patient. It goes back to that. We have to pay the right price for these businesses, especially when they're cyclical, because there is a chance that the economy doesn't get moving again for another 12 months. But we're just starting to sort of have a little nibble at these businesses which are really high quality, which will turn, which are with well-known management teams.
I'll just flesh out something around the composition of indexes. And one of the things that's missed quite often is, in Australia in particular, the composition of what we get to invest in. And if you look at the ASX 200, it's very heavily skewed to banks and resources. But then you go down to the small cap space, there's been a divergence between two various sectors there. The high quality growing companies, which WAM Capital typically invests in, have done very well. The Tuas's, the 360s of the world. These things have absolutely had terrific times. But the composition of the index, the rest of it, is a lot of lithium, gold, small nickel. Companies that have fallen out of the 100 have gone into the 200 and 300. Old media. These things are in decay or in downturn. So what you've seen is that there's bifurcation within the small cap index where there's a handful of companies that are particularly well, but the vast majority of the companies have struggled. And a lot of those companies, particularly small caps, are more cyclical in nature. So if you have global growth coming back, and particularly at smaller resources end, that's when you'll start to see small caps do particularly well, not just the really great companies which these guys have been trying to identify.
Yeah, and it's been similar case in global. Like the market composition is changing as well. Like with the rise of passive investing in ETFs, people who buy the S&P 500, they're not choosing select stocks, they're just buying the biggest stocks, and they're getting bigger and bigger. From our perspective, I think it's prudent for us to stay valuation disciplined, and we think there inevitably will be a rotation away from some of these Mag 7 stocks, which are riding the wave of generative AI, into the names where there's more valuation support, earnings catalysts, and where interest rates falling will be helpful to their bottom line.
Thank you. Beyond, yep. Yep.
Okay. Switched on?
Yep, good to go.
Switched on. Be honest with me. Those of you that own Bitcoin, tell us why, and those of you that don't, tell us why not.
What was the question, sorry?
Okay.
Bitcoin. Those of you that own
I'll take that.
tell us why, and those of you that don't, tell us why not.
Yeah, okay, so I do own Bitcoin. And I think of it just as a store of value. And I think when you've got if you look at the US Federal Reserve's balance sheet, it's a digital gold. It's a store of value. It's something that they've got. The supply is capped. They are still expanding, and it's a bit similar to gold, still producing gold, but the supply is capped, and it's a safe haven. So if it's just and there's also like the trading mindset to me. Like you got to buy it at good prices. So when everyone hates it, you buy it. When everyone loves it, you sell it. So. And I think when you spend so much time in capital markets, you get to play a little bit like that. It's definitely the riskiest investment I hold in my personal portfolio.
Enough pollution. We don't pollute people's heads.
Yeah.
With it. In simple terms, I don't believe and I don't own it because you've seen. I'd love to see a good old-fashioned clean out of the world, a nice little recession, a correction to markets, and I'd love to hold gold versus Bitcoin in that environment because the reality is, all those non-fungible tokens, what are they worth today? Like the
Bored Apes.
The Bored Apes. What are they? They got to millions and millions, and now they're worth peanuts. Yeah. So the reality is, these have not been tested. This asset class has not been tested in a down cycle. We got a glimpse of it during COVID. It almost disappeared then, and then speculation took it to 60 or 70,000. And at the moment today, money is still free. So what happens when the tide goes out? If it's there on the other side of that, then it might get my money. But today,
Trump's going to legalise it if he gets in.
Yeah.
I might not be working for Wilson Asset Management.
I don't.
I might retire.
I think we've got 1 yes and 4 pretty strong. So,
well, I think
audience, anyone?
It's about also if you cannot fully understand the risks and measure those risks. That's my principle. I won't touch it. But, I'm biased because I usually invest in long term. It's easier for the guys to take more risk. But you can't really understand most of the time the risks of the various Bitcoins and in particular measure. Yeah. So it's really hard to make investment decisions in that sector.
I probably should say it's a very, very small.
Don't walk back.
Backtracking. I don't want you to think I've got loaded with coins in my pockets because I don't.
Yeah, I don't own it. At least gold, you can make jewelry. I don't know what you make.
Do you own any?
No. I'm all for. I'd much rather an industrial company that makes a cup and sells a cup at a 20% profit than something that's make believe and I don't understand the use case for it. So, yeah.
The one thing I will say that the blockchain and what a lot of it's premised on has a purpose. Yeah. So forgetting the Bitcoin stuff, which is speculation, the benefits that blockchain will provide, especially to the banking sector and real-time banking, the real-time transaction nature, yes, that is great, and that will eventually change some things. But that's not speculation. That's automation. That's That's evolution. That's systems.
Just over the side there with Bridget. Yeah, thank you.
Yeah, this is just a simple question. Franking credits. Where do you find them in the balance sheet? How long you got of franking credits? Like WAM went down to 60%.
Yep.
Where do you find it in the balance sheet?
It's in the annual report, so we do publish it every year. So you'll find it in there. We don't publish it. We publish our profit reserve every month. We don't publish the franking balance every month. And our view is broadly that if we did, it would be somewhat confusing because the franking balance can, there's the profit reserve is the profit that we make. We generate franking flow through franking that we receive from investee companies and dividends we receive, and that's about a third of it. About 2/3 of the way we generate franking through our LICs is the payment of tax. Obviously, WAM Global is slightly different. We're 100% reliant on the payment of tax. The profit reserve is based on realized and unrealized profit. There's a timing delay between realizing that profit and then paying the tax component of it. So it's published within all of the annual reports. When we're managing the franking balance of each of the companies, obviously we can't avoid tax, but we look to maximize the efficiency around the payment of tax like everybody else. There's no point of us at a corporate level prepaying tax and having tax on the balance sheet. For us, we feel like if we've paid the tax largely we've got to distribute it out to shareholders. So we tend not to hold high levels of franking on the balance sheet. 1 to 2 years usually gives us and investors a bit of certainty around the income that we can pay, and that we can generate that fully franked dividend. Obviously, in the case of WAM Capital and WAM Research, as you were alluding to, they have gone to 60% franked. And both of those companies have relatively large losses on the balance sheet, primarily from the GFC. So the board and the company are just working their way through utilising some of those losses, which is obviously great that we're not paying tax, but it's limiting the franking that we can generate. So in an ideal world, we'd like to get both of these companies back to paying fully franked dividends. But it's just a bit of a balancing act between utilising some of those losses on the balance sheet from the GFC and the timing of realising profits and then paying the tax on it. So it's a bit of a juggling act at the moment. In the case of WAM Capital, just maybe to elaborate really quickly, we are paying a really, really high dividend yield there. I think we're yielding 14% grossed up for franking. So we've got to be doing after tax 15, 16% and turning that portfolio over quickly. So it is a really high hurdle to be able to maintain that dividend and get it back to a 100% fully franked dividend perspective. So we always just kind of like to caution WAM Capital and the sustainability of that dividend. Obviously, if Will and the team keep performing the way they have over the last 12 months, we'll be all right, but it is a high barrier there for WAM Capital. Thank you. Yep, yes, sir, thank you. You're good. Yep.
Okay, thank you for that. Some time ago when the government brought off-market buybacks, took it away from us.
Yep.
I think Mr. Wilson was against that idea originally. Could someone explain to me, I haven't heard much about it since, is that still being challenged or is that a fait accompli?
That's a fait accompli.
Yeah.
So basically the government took a view and the regulators took a view that people like Harvey Norman, who had large franking balances on their balance sheet, what they were doing is they were raising capital to redistribute that capital and redistribute that franking. And they basically said no more of that, and that will never come back. That's gone. So, the distribution of franking needs to be done in the course of business as opposed to raising money and distributing that way. So we won't see that again, unfortunately.
No. And where I think it maybe leads to some complexity is the LIC structures that are going through wind down phase and want to, if they do have, back to the earlier question, if they do have a large franking balance and they're going to close the listed investment company or convert the structure to an open-ended structure, how do they distribute that franking credits to shareholders, and how do they do it in a fashion, as John said, that's in the ordinary course of business? And so we have seen one LIC that is delisted, and there was 5 million worth of franking lost that could have been distributed to shareholders because of the new legislation that was passed. Those franking credits were lost. So, for us, as companies are going through that delisting phase in particular, they have to be very careful going forward, and we've already seen that one example. We're working closely with the sector to make sure if there's any future conversions that those franking credits are fully distributed to shareholders. So, we managed to soften the regulations, but they were still passed, unfortunately. Yep, over here.
Good morning. Thanks very much for the presentation. Could I ask a couple of questions on some Queensland companies? So firstly, Suncorp, now gotten rid of the bank. So is it going to be a good performer from here, being purely focused as an insurer? And secondly, with Boral and Adelaide Brighton both taken over at the smaller end, is there much of an opportunity you see from Wagner's? And also, could you talk about any red-hot takeover targets? And I was wondering, because one of the attractions for the WAM group is you've usually got a pretty good nose to the wheel and suss out
probably Wagner's
targets. And I was wondering whether Seven Media hitting all-time lows might not get taken out by Kerry Stokes just to clean it up.
Yeah.
It's de minimis, but and any other takeover ideas you might have. Thank you.
Yeah, I've just noticed the time. We're getting a red flashing light, and we've got the team for Future Generation up now. But John, do you want to start off maybe with Suncorp and try and
Suncorp's
keep it
a
punchy?
very simple, clean business now, just a pure insurance, general insurance company. Fairly valued, you'll get a good yield. There's a big buyback that will start to support it when they get the cash from ANZ. So just a safe, boring place to be. No stress.
Wagner's would be Oscar Oberg, the lead portfolio manager's most bullish idea at the moment. He loves it. He was caught up with management last week. I think the exposure to Queensland when, the infrastructure spend and pre the Olympics, there's a lot happening up here, and I think Wagner's is a fantastic way to play it. Whether it gets taken out, I'm not sure. But yeah, it's definitely, I think you're on the money there. And then other takeover ideas.
That's what you're talking
about. I'm not sure about Seven West Media. I think it's pretty tough in TV right now, but it is cheap.
Awesome. All right, thanks everybody.
Sorry, Marty, I just want very quick, it's a bit different because we never do this, but being one female across my male colleagues, I couldn't help but see that all the questions were coming from our male shareholders. And I just want to encourage our female shareholders to have more courage to ask questions, because I know I'm going to be very unpopular now. Female investors outperform male investors over long term.
Fair enough.
Thank you, Marty.
I know we'll have to.
One last question.
Oh, okay, one last question. Yep.
Look, it was just a very quick one. Obviously, digital infrastructure is a very popular thematic. Investors in Australia look at the data centre, which is a bit of a buzzword. Are you invested in that space, and how do you do that? Through Goodman or NextDC? And do you have an opinion on the Digico IPO that's coming as well?
Short answer to that is yes, we invest in it, but it's getting tougher and tougher. Goodman's the preferred play because it's less capital intensive than NextDC, because every time NextDC want to grow, they have to go buy a parcel of land, so they need to raise more money. So it's more capital intensive than Goodman that's just converting existing parcels of land. The one that we're kind of interested in more so is the infrastructure for data centres. So Telstra, Spark in New Zealand, they own data centres, but it's also the infrastructure that's provided. So cables and wires and all that kind of stuff. That's undervalued in our view. So that's the next iteration of data for us.
And just on that last point, Genius Plus and Southern Cross, the SXE, GNP, the codes, they're exposed to those real infrastructure and building the cables and putting wires down. We own a little bit of Megaport, which is looking a little bit cheaper. It's taking a little while to play out. We own NextDC, which is probably looking a little bit more expensive, but yeah, we're definitely exposed.
Awesome. Thank you, everybody. And just join me in thanking the investment team at Wilson Asset Management. Thanks, guys. Next up, we've got the team from Future Generation CEO Carolyn Gurney and her panel, Not-for-Profit, and Bill's here. Bill, hi, Bill. So Bill will again give you guys a bit of a different perspective of global markets, so something a little bit different. Thank you.
They say change happens 1% at a time. So what can you do to be 1% better today? You could take the stairs instead of the elevator. You could give a compliment instead of a complaint. Or you could change someone's life. 1% may not sound like much, but for young people in need, 1% can make all the difference. At Future Generation, we invest in a different kind of potential. We're the first listed investment company in Australia that delivers both investment and social returns. Future Generation provides shareholders with exposure to leading Australian and global fund managers. Their job? Delivering a stream of fully franked dividends and capital growth to investors. Our boutique fund managers also have big hearts. By not charging management or performance fees, we can donate 1% of company assets every year towards changing lives instead. As a shareholder, you can decide which of our preferred charities will receive your donation, whether it's helping children at risk or supporting youth mental health. Our carefully selected charities ensure your contribution is used in the best possible way. For shareholders with over 1 million shares, you can direct your donation to any charity of your choice. And as our assets grow bigger and bigger each year, so does the 1% donation. This gives our charities the financial security to think and plan long term. By 2030, we aim to have donated $100 million. And the good news is we're already on the way there, having raised $75.9 million to date. With your support, 1% can make big things happen. To learn more about how you can improve the lives of our future generations, visit futuregeninvest.com.au.
Oh, goodness, that's bright. That's really bright. Good morning. I am Caroline Gurney. I am the CEO of Future Generation, and I'm delighted to be here. And basically, I just want to do, before I do the introductions, how many people have heard of Future Generation? Oh, I love that. That's so good. So how many people hold Future Generation Australia or global? Okay. So I am going to talk a little bit about Future Generation, but you've seen the video, so you have a rough understanding of what it is. But to go back to basics, I think is really important because Jeff Wilson, obviously our founder, he went to the UK. He read a brilliant newspaper, the Financial Times, and it basically talked about how a fund manager had gone out to other fund managers saying he would raise the money if they would work for free because he needed to raise money seriously quickly for cancer. And he did that. He raised millions of dollars for cancer, but he also gave shareholders a really good return. And the way he did that was all of the fund managers, hedge fund guys, private equity, they worked pro bono. So being Jeff, he basically said, Australia can do this better. So he came back to Australia and he spoke to David Paradise of Paradise Investment Management. He spoke to Peter Cooper. He spoke to L1, another brilliant fund manager in Melbourne, and said, will you work pro bono? And they all like, yeah, sure. But let's do it. So he basically 10 years ago, so it's the 10-year anniversary of Future Generation Australia. And he has now convinced 30 fund managers to work pro bono for our shareholders. And that is really amazing because, these fund managers, and he likes to call it a win-win-win, they basically do what they're really good at. They manage money, they're boutiques. And Bill, we're going to come to talk about why he does it and what his view is on the market. But they're really good at that. Their name is on the door, and basically they have skin in the game. So they work pro bono, but it also gives them an outlook that is different perhaps in terms of, their social awareness. Our shareholders, that they are, you own the company, you are incredibly important to us, but you get to invest in these fund managers, whether it's Australian equities or global equities, basically at a very, very low cost. It's not completely free, I have to be honest there, but what it is you are not paying performance fees or management fees or for most of the suppliers. So when we do a video, that's pro bono. When we do with working with Boardroom, that's pro bono. So a lot of people have come together to work pro bono for the benefit of our not-for-profits, but also shareholders. That increasing stream of dividends, really important, that's solid, that capital growth and that sort of preserving shareholder capital. And our social impact partners, and Andy is a brilliant, he's the founder of an amazing organisation, Human Nature. And they basically, we give them untied funding. And untied funding is basically, we say, here is the money, you do with this exactly what you know how to do to help the lives of young people. Just like I would never tell you what to eat, I would never tell an organisation, a not-for-profit, Bill, anybody, what to do with the money because they're the experts. And that's really rare in Australia, but it is sort of globally best philanthropic practice. So we're going to come to that as well. But first off, I would like to, there's the slide where I formally introduce them. But Bill is a fantastic example of one of our global fund managers in Future Generation Global that works pro bono, but is an expert in his field, incredibly good performance over that long period of time. And his fund invests in, it's the Global Small Mid-Cap Fund. And he has a very different view to many other fund managers. So Bill, tell us how you actually invest.
So our strategy is based on price discovery. So I've always
Does everybody
said,
know what that is? So we make him explain it. Price discovery.
Yeah, so it's all about, the way I view it, the market is incredibly smart, but it can also be very lazy. And it can be lazy when companies are going through a period of change. And that period of change could be a corporate restructure, it could be an asset spinoff, it could be a management change, it could be embedded optionality within businesses as well. And what we find is that, a lot of times, how do you add it? How do you differentiate? Where do you get your edge from? And it's about two things. It's one about investing time in researching this company, what it might look like over the next couple of years in terms of its new business potentially, or what that embedded optionality might look like in a couple of years' time, and also time of ownership. So every time I have a call with a company, I say we're long-term holders of businesses. And I always say to them, I know everybody says they're long-term holders, but I've owned companies for 10 years. And my best example is a company called Interaction, which was a data center company based in Europe. And I bought that in about, 10 years we owned the company. And it got taken over by Digital Realty about 2 years ago. And on my last call with the company, it was interesting. They said, Bill, it's like our boys have grown up together. So my boy Nick was 9 when I bought the company, he was 19 when we sold it. So I think that's kind of a differentiation. So we'll look at a company and let it compound over a long period of time, which is, I'm not gonna say it's rare, but it's becoming increasingly rare in this environment.
So when you look at your sort of companies, I'm really interested in the sort of the geopolitical, what's happening out there in the world. I mean, obviously the WAM fund managers spoke about it as well. How does that impact your fund? What's happening in the States? What's happening in the UK, Europe, war? So many things going on at the moment.
Yeah, it's like you're just juggling all these balls all the time trying to figure it out. And you got to admit to yourself, you'll never figure it out. Because how do you determine where macro is going to go? It's almost impossible. I always view it as you got to have a level set of where it is today. And from a geopolitical standpoint, I think it's quite risky geopolitically. I think the market is underestimating what the Russian-Ukraine war is doing, what the Middle East impact or conflict can mean from an energy risk, and we'll talk about that later. You have China, Taiwan potentially in the next couple of years, something happening there. We have the largest election cycle in the world that we've seen for decades. And clearly there's a little one going over across the pond in the US that's creating a lot of ups and downs. The only people that make money out of that right now are the brokers. So they're all telling stories like, should buy this, should buy that, Democratic pair this, Republican pair that. It's very hard to know where it's gonna go. Let's wind it back to 2016. So when Donald Trump beat Hillary Clinton, everybody thought that was going to be incredibly bad for the markets. So when the announcement came out that he won, the futures were down 5 or 6%. Next day, the market rallied, it ripped, and went up 40% in a very short period of time. So again, from a macro perspective, great. You can try to guess what the outcome might be, but then you got to try to guess what the actual impact in the markets will be as well. So what we do, Carolyn, we stick to the stocks and the businesses that we own. It's about owning businesses in structural, secular growing markets, great balance sheets, great management that we get to know over a long period of time, and let them do their own thing and let them compound for us. And hopefully they'll work in most macro scenarios. I always say I like to have a good catching mitt out there in terms of whatever macro gets thrown at me, I can defend myself and have good positions in companies that will benefit from that. But I will say geopolitically, from a risk perspective from conflict, it's quite high. And I don't know if the market's really reflecting that as much as it should.
So one of the things that we are invested in terms of Future Generation Global is that small to mid caps. And small to mid caps globally are huge compared to, small to mid caps in the Australian market. So everybody's talking about this rotation into small caps. I mean, we saw it we saw it at sort of, July, it started again, and then basically the returns have gone in the last month, but now it's coming back again. So for example, I look at ours and we've outperformed for this month. So what do you think?
Yeah, it's a great point on the size, because I really don't like the name of the fund, the Global Mid-Small, because it kind of says they're small cap companies. But I typically look at companies that are 20 billion US and below. So when you have companies with 3 to 4 trillion market caps overseas, clearly companies that are 20 billion are small cap or mid cap overseas. So I always say if my fund was listed here, my average size of company is around 12 billion, I'd be a top 40 company over here. I've got companies bigger than Kohl's. I've got companies similar to size to Telstra. So it's funny. It's that misnomer in terms of that size, which I like to level set, because these are big global multinational businesses, and we'll run through a few later on. In terms of the rotation, so the concept of this rotation has been around for a very long period of time. I've been waiting for it for a long period of time as well. The trouble has been is that earnings growth has been incredibly concentrated with the mega caps. They're in really strong growing markets of AI, social media, you name it. So they're growing quite strongly. That's where most of the earnings growth has been over the last few years. And so as we know, earnings drive prices effectively. And so that's where the market's migrated, and fair enough. If you think of it now, though, from a concentration risk point of view, the top 5 companies in the US, Apple, NVIDIA, Microsoft, Google, and Amazon, they're $14.3 trillion combined market cap. Now, all 2,000 companies in the Russell 2000, their combined market cap's roughly $3.1 trillion. So you're talking 4.5 to 4.6 times 5 companies versus 2,000. So I'm not saying that those are bad. I think they're great companies, and everybody should own some of those companies as well. But what's happened is there's been a massive allocation of capital just in these 5, or call it 10, whatever, the Mag 7 as well, and has forgotten about the smaller caps. Everybody's waiting for this rebound to come, which hasn't happened. I will say that the last 4 months, the global MSCI mid-cap index has outperformed the world by 3%.
Yeah.
So it's bubbling underneath. You don't see this massive rip, but it's bubbling underneath. It is broadening out. And what's changed? We're in a Fed rate cutting cycle, a global central bank rate cutting cycle right now, just starting, except here in Australia. But the thing we'll see going forward is what that does, it helps improve the sentiment, at least around economic activity. There's businesses and industries been in recession for 2 to 3 years. Freight, non-residential construction, they've been in recession for over 2 years. You don't think that is the case because where the markets are, but there's many industries, and that's more the mid-small cap area, they've been in this recession. So you get the rate cutting cycle come through, hopefully helps improve economic activity, which is more cyclical, which is your mid-small cap area. It'll help with the earnings profile. So as I said, most of the earnings growth has been concentrated. Now it's starting to broaden out. You get more earnings growth coming through in the rest of, and that will help drive that realization, that shift over time. Clearly it lowers the lower rates will help lower borrowing costs, help with earnings. And when you think of the valuations out there right now, mid-small caps are at a massive discount to large caps. So the NASDAQ 100 is trading around 43 times. No, sorry, 43 times, yep. And the global mid-small cap index is trading at 23. So it's 20-point difference between the two. And what does that do? It creates M&A. So you'll see a lot of the bigger cap companies look at this smaller end. They're starting to slow down a bit in growth, so let's buy some more growth. So you have all these different factors coming together. But at the bottom point here is that the market loves certainty. Right now you have incredible uncertainty with the US elections. Many companies are saying everybody's holding back, waiting to see what the rules will be. Once we know what the rules will be after this election, then we can continue on. So I think that'll be quite a linchpin once that certainty comes into the market.
I'm a bit of a news junkie in terms of business news, and sort of like you read the FR this morning, and tech slid last night. So there's sort of everybody's waiting for that sort of rotation. But many of our fund managers, and you can see there how many we have on the sort of the global side, are saying that it's beginning to come.
Yeah.
Although, as a gentleman here earlier said, people have been waiting for a while.
For years.
Yeah.
We've been waiting for years. But when a shift starts, like Microsoft's over $3 trillion. That's the size of the Russell. So it doesn't take much movement out of these into this market here to really drive them up. And that takes years from a shift perspective. So once you get, so everybody's been thinking, it's going to start, then boom, down it goes. No, it's not. A little bit different this time. It's percolating underneath in terms of the shift, and it lasts for 4 to 5 years once you get these shifts happening. You just need that certainty come through, and that tectonic plate will start to shift, hopefully, over time.
Excellent. So tell us about some of the companies in your portfolio, because I love a stock pick. What are you investing in? What kind of companies?
The one, so we're quite, what happens is we're quite thematic focused, but we don't target different thematics and just look there. It tends to percolate from the bottom in terms of looking for these great businesses. And there's 4 thematics that are really pronounced in the portfolio. One is AI and data growth. Clearly, that's being driven by a number of factors. Data growth globally has typically grown 25 to 30%. I believe with, and that's just us with YouTube and Netflix and the like, but now we're going to have machines talking to each other. And I believe we're going to see that data growth accelerate from here, so probably 35 to 40%. So we are not trying to pick any winners. We're picks and shovels at the end of the day. So we like to buy businesses that provide the optical connections, so like a Ciena. Companies that do all the testing, so like an Advantest. There's only 2 in the world that test your the mobile phone in terms of your chips, and they have like 55% market share. So companies like that in AI data growth. Then we have circular economy companies. We have the road to net zero companies. And the one I really wanted to focus on right now is the energy resiliency basket that we've got. And when you think of what's happened with Russia, Ukraine, you think of the Middle East, there's a massive risk and focus on energy security. A little bit less about price is what it used to be. It's more about, can I get it and where's it going to come from? So energy security is being really driven by this geopolitical conflicts that we're seeing as well. And when you think about the world wants to decarbonize at the same time, so it's pretty difficult. So I need energy, but I want to decarbonize, so I need to shift my whole energy mix. And that means we need to electrify. And the world is electrifying. When you think of the electricity demand versus energy demand, electricity demand is twice what energy demand because fossil fuels are going down, where renewables are going up. So that's why electricity demand is growing so much faster. Now with that demand, it's being driven by electric vehicles, the heat pumps, appliances, and now we have AI really driving demand dramatically and creating an issue in the markets in terms of the grids, in terms of demand. And AI wants energy, but they also want it to be clean as well. So there's your other angle there. It's interesting in terms of the world, electricity is going to be the heart of all this, and 80% of all future generation is going to come from renewables, say wind or solar. Nuclear is catching a bid now, and I'll talk about that in a second. But the World Energy Outlook has just come out, and they were saying that they expect electricity demand, or the amount of electricity demand will double by 2050. And take this with a grain of salt, because this sounds like a big number, but between 2023 and 2035, 1,000 terawatts per year, which is the equivalent of Japan. Even if you have that.
Data centers as well.
Yeah, the whole, and that's creating, we've always had flat to kind of lower energy demand because of LED lighting, all efficiencies, and now it's shifted. It's a massive difference now. But we need to be clean. And what that, the name around this is called the energy trilemma. And what that means is we need more resilient and secure energy. We need it to be clean, but we need to be affordable as well for all of us and companies and the like as well. So that's the energy trilemma that is really percolating out there right now. So that's a big long-term theme. The energy grids of the world need to get bigger, smarter, and cleaner at the end of the day. They've been around for 80 to 100 years, so they're like these monoliths right now in terms of the shift. So I'll give you 5 companies involved in this, and I know we got time done pretty quick.
5 picks?
Yeah.
Oh wow.
Yeah.
Okay.
So first one's
That's more than we've ever got before.
Well, this is a theme. It's got decades, and I think this is. And I'm more than happy to run through them all. So KBR.
I don't have enough time. Sorry.
Yeah, I'll go through them really quick. So KBR, $9 billion market cap company. They're all about delivering clean and affordable energy. 60% of the world's ammonia plants are based on. It's a technology company in engineering. 60% of the world's clean ammonia and hydrogen's on their technology. 40% of the world's LNG is built in the world on their technology. It's a massive shift that's happening. They're a key player in the space. Then you have AspenTech. It's a software company. And all these grids have to be managed on software. It's about the flow. So you have all the wind, solar, everything being connected in, and the utilities are saying, what the hell? Like, how do I manage all this? So they use AspenTech's software to manage all of these disparate inputs into their business. And what they do from a market share point of view, all of India is managed by their software. 60% of the world's refining on their software, like 30 or 40% of North American assets on their software. Amazing infrastructure business and growing quite strongly as well. And we had Itron who reported last night smart meters. So AspenTech helps the grids to the substation. Now we got all these houses putting solar on, we got plugging in EVs, putting in heat pumps. So how the hell how do the utilities manage that? So we have Itron, which is a smart meter company. Major major player in the world. They reported last night, upgraded their numbers. They help manage that whole end market, the last mile. Now, the world's talking about nuclear. All the major hyperscalers are doing deals in nuclear right now. 450 reactors in the world. There's only 6 real nuclear technologies. 2 of them are Russian and China, so put them out, so there's 4 Western. We own AtkinsRéalis, which is a Canadian company, around 12 billion market cap. They have the exclusive rights to the CANDU Canadian technology in terms of nuclear. And then we own a company called Curtiss-Wright, who is a strategic alliance with Westinghouse. So we have 2 of the 4 right there. The other 2 are French and South Korean. Now, nuclear is 5 or 10 years away in terms of builds, but those 450 reactors need to have life extensions, and Curtiss-Wright and AtkinsRéalis are big players in this extensions, and they're growing 30 to 40%, doing all this rekit and extending the licenses as well. So there's 5 companies that are really involved in that bucket of the energy resiliency. And sorry, it was.
And if you didn't get all those, we're actually going to put all of our stock tips from the roadshow on the web as well. So from my point of view, like some of that I understood, some in terms of the global companies, and so I love the fact that we have fund managers who are experts in these areas, and obviously having 30 of them. But I'm very briefly, because I really want to get to what Andy is doing in terms of young people's health. I just want to talk about Future Generation Australia, but I'm very happy to answer questions afterwards. So Future Generation Australia is obviously chaired by Philip Lowe, who is the ex-RBA governor, and he is incredibly focused on our dividends. He's incredibly focused on our performance, and he's working obviously with the board, but also with the investment committee. The investment committee we have, is comprised of people like from Jana, from Zenith, who actually advise super funds on where to advise, what kind of construction in their portfolio. So as you can see there, our 12-month investment performance was 21.4% to the end of September, and our grossed up dividend yield is 7.9%, so sort of pretty much up there on the 8%, and growing fully franked dividends, and that's been since inception, and that's what the board is focused on as well. I mean, in terms of our total shareholder return, for the full year with franking, it's 20%. So they're solid, but they're outperforming the small ords, and they, in terms of their 1% plus generally over the period that been launched of the all ords. So they lower volatility than market, and you have access to these fund managers pretty much at a very good rate that you wouldn't normally perhaps able to get into. Briefly, Future Generation Global. Globally, I think it's really hard. You do have that Magnificent Seven, and they are obviously a large part of the index. But we really are, I think, giving a pretty solid return in terms of that 20.2% to the end of September. Because we are small to mid cap, so we don't have a lot of exposure to those big ones. So I think as it's sort of changing, with the investment committee feels that where we're positioned in our portfolio, and we've changed a number of fund managers as well, is actually going to make sure that we're there for that sort of alpha that small caps give you. Grossed up dividend yield, 7.7%. Then the TSR is 19% in terms of 2024, including franking. As you can see there, dividends, 4 years ago, we went to twice a year. And that was a decision the board made because our profits reserve was healthy. It's 8 years now. And so we sort of increased those over time. And sorry, with FGX, we have a profits reserve nearly 6 years, so it's 6.3 years, 6.3. So without further ado, I'm actually going to go to Andy, but one thing that I think is really valuable, and when everybody said in terms of how they buy shares, CommSec actually rebate all brokerage buys through their system. So, not only do we have fund managers working for free, we also have CommSec, which, so when Jono talks about CommSec as an investment, I think it's fine. And then the money that we've given, it's really incredible since inception. I really think so many people are to thank for that. The boards work for free, the investment committees, and obviously, people like Bill, in terms of giving 87.2 million to amazing not-for-profits, and we have 24 we support. And if you look at the savings, because I think that's really important to see, that is the savings that have been given by everybody working pro bono. So really, we're not actually giving out all the money that we've saved. So that actually then goes back to the shareholder.